Welcome to ETM Analytics' recap of 2024. I'm joined by Director George Glynos. George, as we close off 2024, it was an eventful one, to say the least, roller coaster ones. Things that happened that weren't on any of our bingo cards to happen in 2024. So it's been a bit of a crazy ride. And as we started this year, one of the big themes and one of the big questions were, when were interest rates starting to come down? When were the cuts going to come? And if I remember correctly, when we started the year, we were looking at, I think markets were anticipating 6, 7, 8 rate cuts at some point in time. That obviously tapered off as inflation started coming down. We see the labor market in the US cooling a little bit as well. But this trend with the cooling inflations, interest rates still on a downward cycle, that trend is likely to continue as we head into 2025.
Yeah, I mean, it's been an interesting year. What started off, I think if I remember correctly, it was around about January or February, the market was particularly concerned about a very big economic correction that was going to find expression in the form of a recession. We were looking at some worrying data coming out of America that was pointing to that slowdown, and so the market moved quite aggressively to price in some fairly dramatic moves by central banks around the world, and the markets moved that way in a sense to preempt what the central banks would do, because they all felt that the central banks would not allow such a deep recession to take place. So they priced in very aggressive interest rate cuts. That gradually moderated through the year once it became evident that the US economy was in fact holding up pretty well. A lot of people were left scratching their heads, wondering how on earth it was possible. But really, I think the answer to that lay in the amount of stimulation and the kind of stimulation that was applied during the pandemic, and how the lagged effects of that took a lot longer to wind out or through the system than was initially the case. So you're quite right. Inflation started to come down, and ironically, that's when the market started to price back out the chance of some aggressive interest rate cuts, and they seem to have settled on a far more conservative trajectory. And I think the trajectory as it stands right now is pretty realistic. I would say, if anything, it's maybe slightly conservative, but nonetheless, it's certainly positioned for central banks that have got inflation in their crosshairs. They want to make sure that not only does inflation come down, but remains down, and in the process just ease some of that pressure on households.
We're seeing, obviously, the central banks remaining very conservative, and there's various reasons for it. There's so much uncertainty, and one of them being Donald Trump entering the Oval Office for his second term in the beginning of the year. Now, whether Trump is going to go full out with all his aggressive tariff suggestions that he made on the campaign trail, that remains to be seen. But and I know it's very difficult to pinpoint and calculate and build a model around exactly how much impact such widespread tariffs will be. But there's a lot of people and a lot of experts that's very concerned that this aggressive tariffs will cause a second bout of inflation. And that's obviously what the Fed and everyone else is also monitoring. But, apart from, what will the tariffs be and what will they do, there's just so much, I think, concerning undercurrents in the US economy. The debt situation, for example, their fiscal position is concerning, that it's very difficult at this point in time to go, 2025, the dollar will do this or the economy will do that. It's becoming very tricky to actually pinpoint or look forward to where this all will go.
Yeah, Ilze-Marie, there are many cross currents that are blowing at the moment, and I think if I can, just to take you through to a slide that I put forward on Trump as he comes to power, because there are so many considerations that it's difficult to make head or tail of exactly how it's all going to play out. So, for example, on the one hand, we believe that he's going to be an important player in ending these wars. We know that he's going to put NATO under a lot of pressure as he comes in, and get them around a negotiating table. We know that he's got a relationship with Vladimir Putin that, the Biden administration simply didn't have. So I think he's got some leverage there that he can apply, and he'll get all parties around a table. Now, that might be great for overall risk appetite, and maybe it even lowers things like oil prices and whatnot, which would be good all round. So from a risk appetite, that's really, really positive. On the negative side, though, for America, ironically, there is a reduced requirement for their munitions and their arms. Now,
Mm.
you can counter that to some degree by America just penciling in a significant portion of their budget to be spent on their military, such that you can placate the military complex or the lobbies that are sitting behind the scenes and impacting very heavily the way that U.S. Politics unfold. But the obvious stimulation that was being generated out of blowing up Russian installations is probably going to decline, and as it declines, it will detract at the margin a little bit from that U.S. economy. The same exact thing could be said about what's going on in Israel. So geopolitically, you want to end wars, that's great. On the flip side, it does remove some of the stimulation that takes place. But you would suggest, I think I would suggest that there's probably more than enough good that will come out of ending wars, that it'll more than offset the negative. So let's give him a tick on that one. He wants to implement tax breaks. Well, that's again good for economic growth. Not such good news for the fiscus. As it is, they are running very significant budget deficits, and those budget deficits are not likely to get any smaller under a regime of tax breaks. So, he's going to have to fund that out of somewhere. And that probably takes me straight into that fourth point over there, which is slashing the size of the U.S. government. We know that he has established this Department of Government Efficiency, otherwise known as DOGE, run by two ex-entrepreneurs or current entrepreneurs that are willing to give of their time to try and advise the Trump administration on how best to do this. Well, that goes hand in hand, but I doubt that it's going to be particularly quick or easy to just slash the size of the U.S. government. I don't believe it's going to be possible from one day to the next. And as such, I think going back to the tax breaks and the impact on the fiscus, you'd probably still venture to guess that there'd be a negative impact on the fiscus, at least for the first year, easily dragging through into year two and possibly longer. So there are some big question marks around that, and that'll impact the dollar. It will impact the way that financial markets trade and what they price in. Then, of course, talking about pricing things in, there's been a lot of concern about what's going to happen on tariffs. And tariffs are a big story at the moment because it speaks to that protectionism that Trump gave us a taste of in his first tenure. And already you can see some of the effects on Chinese markets. So the Chinese yuan, for example, coming under fairly significant pressure. A lot of Chinese companies trying to export as much as they possibly can out of their existing stock levels, such that they can try and mitigate the effects of any tariffs that are introduced as early as January next year. So that is something that is going to weigh on global trade dynamics and may even induce inflation, depending on how it is how those tariffs are implemented. So there's pros and cons on both those fronts. And then, of course, the last but not least is talking about mass importation, mass deportation, and border controls. Again, on one hand, that demographically speaking, you need an ever-increasing population to ensure that you've got very strong, robust fundamentals driving that economic expansion. On the flip side, you want it controlled. You don't want a very poorly educated, criminal type activity flooding into your economy with no prospect of being able to contribute right off the bat into that economic prosperity that we're talking about. So there's a lot of cross currents blowing here, Ilze-Marie, and it's difficult to know how Trump's tenure at this stage of the game is going to play out. I will, however, say that at least initially, it'll probably be a dollar positive event. down the line, unless they get their fiscal house in order, I think that could easily switch into a negative dollar story, because they will be losing control of some of their fiscus unless they get a lot of success in slashing the size of that US government.
You mentioned that Trump has hinted that he would likely ramp up a trade war with China. It's already having an impact for China. They've pumped in a lot of stimulus measures to really just get those growth markers ticking over. And while growth is certainly a problem for China, there are some deflation concerns that are starting to pop up, and that could possibly hold consequences for countries like South Africa, obviously.
Absolutely, and here again, right on cue, we've got our indicators that give us a sense of what might happen with Chinese prices. The fact that we've got M2 money supply growth that is as subdued as it is in China tends to point to the possibility that deflation could very well happen. We know that because as you can see from the accompanying chart, there is a correlation between how money supply has unfolded and how it has manifested in underlying inflation. So that is something that we obviously have to take into consideration. The softer the credit cycle, the less room there is for inflation to take hold. And because China is the world's largest exporter, it will tend to export that inflation to the rest of the world, including to countries like South Africa. So there is a disinflation theme that can emerge out of this China story. And I think it's something to pay attention to. Because if we do get some downside surprises to inflation, well, that gives the central banks a little more room with which to reduce interest rates. It also eases the pressure on households, more broadly speaking. So, we had the flip side of that through COVID, and you can see that that spike that emerged through COVID, even in China, which is as productive as it is. Those kinds of things can deal the global economy a tremendous blow. And so the fact that we're talking about disinflation and the possibility of Chinese deflation being exported to the rest of the world will probably help ease the pressure on households and in a roundabout way even assist in propping up global GDP.
Obviously, as South Africa's biggest trading partner, we will be watching China and its deflation situation, and it also obviously comes at a time where I'm not going to say good because I might jinx it, but at least South Africa had a more stable year, all things considered. I mean, load shedding is, for now at least, done and dusted. We're far over 100 days already without load shedding. We had a good, strong outcome of the South African elections. The rating agencies have been giving us a friendly nod recently. So, like I said, I don't want to jinx it, but it feels almost like South Africa is at least getting their house somewhat in order to move into 2024 and hopefully just build on that and really see the economy progressing. But we might just be looking at the surface and things are looking better. But are there some red flags that you may have picked up that might be concerning that we are missing?
Yeah, so Ilze-Marie, there are always red flags, and there's no question about it. When it comes to South Africa, the most dominant red flag is, of course, the fiscal policy that gets adopted by the country. But before we get there, and I'll touch on that fiscal policy in a bit, but before we get there, there have been some cyclical signs of an upswing, and it's neatly reflected in our short-term economic conditions indicator and our macroeconomic conditions indicator. That's reflected by the green line, almost headed back into buoyant territory. We suspect that will come through the months ahead. So we're anticipating with much anticipation that there's going to be some improvement in economic activity that we'll be able to latch onto, not just because the Reserve Bank has reduced interest rates and because central banks abroad are reducing interest rates, but because there's been some genuine movement and at least the GNU at this early stage of the game appears to be making all the right sounds and indicating that it is likely to implement some deep-seated reforms that this country's been crying out for a very long period of time, and most of that is going to be related to leveraging a lot more of the private sector, its capital, its abilities, and its propensity to run things a little more efficiently than what we've had from government in recent years. But as I said, there are always concerns about South Africa's blind spots, and it's probably its biggest blind spot is reflected in this chart, and that's our ability to run a tight fiscal ship. Now, that tight fiscal ship, let's just stick to the chart on the left for the time being, because the chart on the left and the blue line in particular is the line that government likes to put forward. It's our budget deficit, and you can see that there's been some progress in narrowing that deficit to levels closer to around the 5% mark, but there's still a long way to go. That deficit needs to be smaller than 3% to GDP. That would be along the lines of what is reflected in that dotted blue line heading back up again. It actually has to go a lot further than that. And the only way that you're going to get that right is through deep-seated reforms. And that means slashing government expenditure. It means collecting more taxes. It means growing your GDP. So we've got to adopt pro-growth policies whilst at the same time reducing the expenditure of government and improving our tax collections. If we can get that mix of three right, then there's a good chance that we can rectify the situation. Certainly the ratings agencies over the past 2 weeks have sounded a lot more positive on South Africa, even upgrading, I think it was Fitch upgraded South Africa's outlook on its credit rating, which is always an early sign that the next move of the credit rating agency is going to be up. The danger, or the biggest red flag in all of this, I think is reflected by the growing jaws, the disparity between the black line on the left-hand chart and the blue line. And we've termed this net borrowing. Net borrowing takes into consideration the bailouts that have ensued for the likes of Eskom, as well as redemptions of bonds that were maturing and need to be covered and paid for. So net borrowing in South Africa is actually a lot worse than just what the budget deficit leads us to believe. And the real danger here is that from the data that we've been looking at is reflected in the right-hand chart, and that's that a lot of this difference in this debt that's been accumulated is now being funded in very short-term instruments called treasury bills. So we're talking about anything from 3 months to 12 months. Now, on one level, I understand the logic of wanting to do this because you are going to be paying out lower interest rates. On the flip side, however, is that it raises the degree of vulnerability in the short term. So if you have a short-term shock that hits the system and you need to access liquidity fairly dramatically, the problem here is that you've already tapped into a market that you could have tapped into. And so it leaves you a little bit more vulnerable and less flexible in your response function, which is something that I think we need to be a little bit aware of and maybe hold the authorities to account on this and to tell them, that we're watching you. We don't like the fact that you're borrowing this much at the short end. We understand the necessity to use the short end of the yield curve and all of that. But, I think over time, they're going to want to roll this out deeper into the curve rather than just relying on the short-term, highly liquid treasury bills that essentially are placing more and more emphasis on the banking sector to help fund what's essentially a government debt problem. So these are some of the concerns that we have in South Africa. As always, it's fiscal. The Reserve Bank has tended to do a really good job. SARS has done a respectable and reasonably good job. So it's down to the fiscal authorities and the kind of controls that they choose to put in place. I think in Enoch Godongwana, we've got a good finance minister that understands the problems that South Africa faces and the very real trade-offs that you get between spending on social welfare and spending on things like infrastructure that are so critically important to any economy. Now, in South Africa's case, that has been lacking. And, just to show you just by how much we've been lacking is the accompanying chart, which shows the very subdued levels of fixed investment in South Africa relative to GDP. That figure of 14.6 is roughly half of what it should be, to give you an idea. Now, during the Trevor Manuel era, we were targeting levels of around 25%, which would have been the EM average, which I think is a respectable number. We were well on our way there, and then the global financial crisis hit. Now, you can forgive the authorities for not spending during that global financial crisis, because there was a huge amount of uncertainty. And the aftermath of that NDP that was launched, there were signs that it was starting to move back in that direction, and that would have been good news. But unfortunately, the Zuma era that followed made sure that none of that fixed investment was going to be the focus of his tenure. In fact, all he wanted to do was spend on social welfare, neglect things like infrastructure. The net result is that we've got a huge problem, and that's investment as a percent of GDP. That figure there has to tick up, and it has to tick up strongly. And if it's one word of advice I would give the government of national unity, it would be to make sure that every single decision that gets taken by this government needs to in some way contribute towards raising this number. It's got a long way to go, but it's a journey that we need to begin.
So how do we do that? Is that simply a case of cutting back on social welfare programs and taking that money and spending it in infrastructure? Is it a combination, perhaps, with, upping government revenue? How do we get from 14% back to 25%? Because that's not a small jump.
No, it's not a small jump. And I think the answer to that question, or the solution to it, is that you don't have to rely on government alone. What government can do is, if it doesn't want to take a step back on some of its social welfare, which we know would be difficult, would be allowed to allow the private sector in to pick up the heavy lifting, make that investment, run some of these big state-owned enterprises a whole lot more efficiently than they're currently being run, or at the very least participate in helping those state-owned enterprises suddenly extract efficiencies that used to be there, but just aren't there anymore. So if government isn't prepared to cut back on its social expenditure such that it can spend more on infrastructure, then it must, by definition, include the private sector that has the capital and has the ability to spend it, and wants to spend it if it gets given a good opportunity to make some profits. It will want to invest that money, and the more business friendly we make this environment, the more we allow the private sector to pick up that heavy burden, the greater the probability is that this number will rise. And it's going to take at least a decade, possibly two, for us to get to the levels that we want. But every step, every decision that gets taken, if it's taken with the idea of boosting this number, will contribute very meaningfully to GDP growth, which again, going back to those fiscal numbers, will help those fiscal numbers improve, for the simple reason that you're going to have a GDP that's progressively growing at a more rapid rate, A, because the private sector is getting more involved, but B, also because infrastructure is slowly starting to come back to life and produce some of the efficiencies that this economy is crying out for. So there's a lot of positive to come out of inclusion of the private sector. Over and above that, by the way, we can also consider the effects that greater inclusion of the private sector will have in generating more tax revenues. So again, the more you include them, the bigger the pie that you can collect tax from, the easier it is to run these fiscal numbers in a more prudent and less draconian or less restrictive way. So this is, I think, the key. The key is for government to step back and allow the private sector in and to do what it does best, and that is explore opportunities, extract efficiencies, make some profit that renders these things sustainable over the long term, and generates that GDP growth.
Yeah, perhaps we need our own Doge department. If Musk is done in the US, he can hop on over to South Africa. Apart from the domestic issues, the international issues that we spoke about, it really sets the stage for 2025 to be somewhat volatile. And as for the rand, we know it acts like the tip of a dog's tail. If it swings left, it swings left hard. If it swings right, it's going to go hard right. So, looking and stepping into 2025, whether we consider Trump, whether we consider the wars, whether we consider what's happening in Europe, by the way, because Europe's economy is not looking all that great. And in China, there seems to be a lot of volatility that we can anticipate for the new year. So how does one prepare, at least from a ZAR perspective, for a volatile time ahead?
Yeah, Ilze-Marie, it's always very difficult because that volatility can strike at any time, and it's almost neatly reflected in the accompanying chart. I mean, you can see just how volatile some of these developments have been. And so, the rand was looking like it was stable and strong for a long period of time, and now all of a sudden, through the course of the past month and a half, it's come through a significant correction. And that correction has resulted in some angst within the market. We were trading at close to 17 to the dollar at one point. We're now comfortably north of 18 and looking like we are going to weaken a lot further. And that impacts inflation, it impacts interest rates, it impacts the attractiveness of South Africa's bonds and all of that. That being said, let's be thankful for the fact that the rand, as per the current chart that's on the screen, is still the best performing emerging market currency out there. So South Africa's done quite a few things well this year. And I think, again, reflects the benefit of the doubt that the market is giving this government of national unity. What now needs to follow are the reforms that they've been promising. And if we get those SOE reforms, in other words, the private sector inclusion, if we get the fiscal reforms where you have some fiscal anchors that prevent politicians from being able to spend aggressively, as happened during the Zuma administration. If we can make more progress towards getting South Africa off the grey listing, all of a sudden the rand starts to look a lot like a more stable currency than what we've had up until now. And in terms of ultimate valuations, well, these valuations at this stage of the game are moving back in exporters' favors. As updated as of this morning, we've got some data that tells us that exporters are likely to find some good attractive levels with which to trade at and lock in for future benefits. So at this stage of the game, I'd say the rand is offering some good export opportunities, but that's the way you play it. You trade that volatility. If the volatility moves in your favor, don't be greedy. Jump at it with both hands and take advantage of it.
Well, it's been an eventful 2024, and if my gut tells me that 2025 is also shaping up to be an interesting one, it might be a little bit volatile, so make sure we hold on to our bootstraps for it. But I'm sure the last couple of years have prepared us for whatever it is to come. George, thank you very much, and we will chat again soon.
Thank you, Ilze-Marie.